Before we get into the data, I want to take a moment to mark something. You're watching the SpaceIQ briefing for the first time from a new home. The NASDAQ market site, right here in the heart of Times Square. This isn't just a change of scenery. The NASDAQ has listed some of the most consequential companies of the last 50 years. Microsoft, Apple, Amazon, Google. It's where the technology economy came to be recognized. The space economy is next. Space Capital has partnered with NASDAQ to bring the SpaceIQ briefing here because we believe the space economy deserves to be covered with the same rigor, the same credibility, and the same sense of consequence as any transformative technology market in history. The space economy has earned its place here, and this is where we cover it. And I'm glad to have Jeff Thomas here with us, Executive Vice President, Chief Revenue Officer, and Global Head of Listings at NASDAQ. Jeff, NASDAQ has watched every major technology wave come to market. Where does the space economy fit into this arc? And as this category matures, what are you following most closely?
So our purpose here at NASDAQ is to connect capital to opportunity. And so for every major technological revolution, NASDAQ has been there to support its growth. From personal computers to the internet, to the mobile revolution, to cloud, and now AI. We're there to help fuel that growth and innovation by empowering those entrepreneurs to raise capital to build the future. As we look forward to the potential of the space economy, I see so many opportunities for every single one of those different industries to be completely revolutionized by the opportunities in space. And that's why we're so excited to be here with you today and talk about how we can help investors understand the opportunity in the space economy.
Amazing. We're so happy to be here. And that context really matters because what we saw in Q1 is exactly why this conversation belongs here. Now let's get into it. Most people think of the space economy as just rockets and space stations. We think of it as the invisible infrastructure layer of the global economy. And SpaceX is the clearest proof point. The expected IPO at a reported $2 trillion valuation has forced a reckoning among allocators who have yet to size their exposure to this market. And to understand why that reckoning is happening now, you have to understand the company behind it. SpaceX may be the greatest capital efficiency story ever told. In 2019, SpaceX launched 26 times, once every 2 weeks. In 2025, they launched more rockets than every space agency and company in the world combined, averaging one launch nearly every 2 days. The Falcon 9 family has now flown nearly 700 times with a 99% success rate. What makes this story even more remarkable is what happened after 2021. Equity funding effectively flatlined, but operational output accelerated dramatically. Starlink began generating enough subscription revenue to fund operations and R&D internally. SpaceX became self-funding at the exact moment that most companies would be doing their largest capital raises. The business became the investor. Same $10 billion of capital, the output just kept compounding. And the contrast with Blue Origin tells the other side of the story. Jeff Bezos has personally funded Blue Origin since its founding in 2000. And our analysis, based on headcount, product maturation, and contracting activity, suggests $27 billion in founder investment over 25 years. Blue Origin's entire launch history across both vehicles totals 39 flights. New Glenn, their orbital rocket, has reached orbit exactly twice. $27 billion invested, 2 orbital launches. Capital alone doesn't build great companies. Conviction, velocity, and an obsession with the problem do. SpaceX didn't just win the space race. It rewrote the rules of capital efficiency. Total investment in the space economy hit $36 billion in Q1. That's not an annual number. That is 1 quarter, and it shatters the previous quarterly record. It wasn't driven by a single mega round or a one-time anomaly. It was broad. Applications companies, distribution companies, infrastructure players, all of them racing to leverage what's been built in orbit for physical intelligence, robotics, and AI. Infrastructure investment alone reached $7 billion in the quarter, on pace to exceed the full-year record set last year. And to put the $36 billion in context, total space economy investment since 2009 has now reached $455 billion across more than 2,400 companies. Q1 alone represents roughly 8% of everything ever invested in this category in a single quarter. And capital wasn't just going in. Investors realized $8 billion across 28 exits in Q1, including 26 acquisitions and 2 public debuts. The market is maturing on both ends simultaneously. And that changes everything for allocators sitting on the sidelines. The capital is moving fast, the narratives are consolidating, and the architecture of the space economy is being redrawn in real time. The most significant structural shift of the quarter wasn't a launch or a funding round. It was the emergence of orbital data centers as a credible, well-capitalized candidate to be the first heavy industry to move off planet, and the realization that companies that own the launch infrastructure are best positioned to dominate it. This is now a platform war. Start with SpaceX, the Terafab announcement, a new facility targeting a terawatt of processors annually, paired with an AI satellite that's taller than Starship V3. It's not a pivot, it's a natural extension of the Starlink foundation. SpaceX has spent a decade building the most cost-efficient orbital logistics system in history. Now it's using that infrastructure to run compute. With the acquisition of xAI and Elon's March event in Austin, the signal is unambiguous. SpaceX's long-term competitive moat isn't just launch cadence. It's compute in orbit, at scale, at a cost no one else can match. SpaceX is already the world's most valuable private company at $1.25 trillion, worth nearly 3 times the entire cumulative investment in the space economy since 2009. That means that investors aren't paying for today's business. They're paying for the platform that owns the next 50 years of orbital infrastructure. Blue Origin followed with Project Sunrise, a proposed 50,000 satellite constellation with optical downlink capacity, suggesting hyperscaler-grade transport. The structural read here matters. This is Blue Origin building the constellation, not Amazon. Rockets and compute are becoming deeply intertwined at Blue, just as they are at SpaceX. The architecture points toward a single institutional anchor customer, a hyperscaler or a government that makes the whole system viable. That's the same playbook as Starshield. Then, NVIDIA made its position explicit. At GTC, Jensen Huang unveiled the Vera Rubin Space One module, a computing platform purpose-built for orbital size, weight, and power constraints. His words, "Space computing, the final frontier, has arrived." That's not a product announcement. That's a market declaration from the most important infrastructure company in AI. And Google's Project Suncatcher, a TPU-equipped, solar-powered satellite constellation targeting prototype launches by early next year, rounds out what is now a 4-horse race among the most consequential technology companies in the world. When Google builds its own constellation rather than buying capacity from someone else, the thesis is confirmed. The frame has shifted. The question is no longer, will orbital data centers work? The question is, who owns the rails? While capital markets were moving, so was Washington. Administrator Jared Isaacman moved quickly in Q1 to put his imprint on NASA, and his first act set the tone for everything that followed. Isaacman formally reclassified Boeing's 2024 Starliner crew flight test as a Type A mishap, NASA's most severe designation, placing it alongside Challenger and Columbia. This was not a bureaucratic reshuffling. It was a declaration that the agency's relationship with its legacy contractors is being fundamentally renegotiated. The Artemis architecture reflects the same logic. NASA will invest $20 billion over 7 years to build a lunar base near the South Pole, while halting plans for the Gateway. Boeing's SLS has been stripped of its core role. SpaceX's Starship will now dock with the Orion spacecraft in Earth orbit and carry the capsule toward the lunar surface. The economics tell the story. SLS costs more than $4 billion per flight. Starship's early pricing comes in at $90 million, or $900 per kilogram, a figure that Voyager disclosed in their 10K for the Starlab contract. That's a generational step change in cost structure, even if that pricing will rise as demand scales. The ISS to commercial LEO transition adds another layer of complexity. NASA is weighing an alternative approach to supporting commercial LEO destinations that could upend deployment plans for programs already underway. Nearly $4 billion in private capital has been invested into space stations to date, so this policy moment warrants close attention. The policy is moving faster than most people realize, and the companies that have already deployed capital are the ones who will define what replaces it. NASA's proposed changes to the commercial LEO destinations program don't happen in a vacuum. They happen to real companies with real capital deployed and real timelines on the line. Joining me now is Max Haot, CEO of VAST, the company building Haven 1, the world's first commercial space station, and a space capital portfolio company. Max, welcome.
Yeah, thanks for having me again, Chad.
NASA is signaling a potential restructuring of how it supports commercial LEO destinations. From where you sit, what's actually changing, and what does it mean for VAST's timeline and plans?
Yeah, for context, the ignition event that occurred, 3 months in the tenure of Jared Isaacman as the administrator, announced many things, and one of them was CLD. Just a first word, it's amazing that Jared Isaacman was able to do so much in so little time, and so many exciting announcements for America's space superiority. All of the moon increased cadence and the moon base, we are big fans and we're very excited and are responding obviously to all of the opportunities in RFI. Related to the CLD, the commercial LEO destination, if you take a step back, in 2018, President Trump announced the concept of transitioning our presence in low Earth orbit from a government-owned and operated space station, which is the International Space Station there right now, to a commercial space station or multiple commercial space station where NASA and the other international partners are one of many customers. And so you could think of it as a commercialization, commercial transition. Instead of owning and building it, they are basically becoming a customer of the service. And this is very similar to what has occurred to the transportation side that created the Dragon capsule and the Starliner capsule with great success. That announcement back in 2018, created an industry working with NASA, including VAST and some of our competitors, that are expecting this transition in about 2030, at the end of 2030 when the ISS is retired, and expect also a large procurement this year called CLD Phase 2. So back to the ignition event, what happened is that NASA basically made a proposal for an alternative plan. And that plan is for them to design, of course they will use industry to build it, but to design a core module, they call it, and that will temporarily attach to the ISS and then detach. But the big change in that proposal is that they are saying that NASA would design it and would own it. Industry will build it in the same way as industries built the SLS rocket, but it's a very different approach than the promised commercialization approach, which we obviously think is the right approach to make sure America has a continuous presence in low Earth orbit by the time the ISS is retired. Now, to reframe it, it's not a change. So at the end of the day, Jared Isaacman at a press conference made it very clear that this is an idea, this is a proposal, and what they want is to receive feedback. And the form of the feedback was an RFI, request for information, that was due about 10 days ago. And of course, we followed the process with our partner NASA, and we obviously listened to their plan, we considered it, and we responded to the RFI on time. In terms of the proposal, our view is that it is not the right way to make sure that we have a replacement of the ISS on time. The ISS has a leak issue. The ISS is a partnership with Russia, which geopolitically is challenging. And so our view is that the right path is to continue down the commercial route, to basically select as soon as possible 2 companies and to use the budget that has been allocated for the commercial LEO destination, which in our view is adequate to not only fund the development of 2, obviously VAST hope to be one of the 2 and winner, but also to share the utilization for a permanent crew between 2 stations if the 2 of them succeed at building it. So in our view, the budget is adequate. If they move quickly this year and award to 2 companies, there's still enough time to be ready by the end of 2030. And this is by far the right path within the budget and the timeline there is to pursue. So we've obviously advocated for our view and what's right in our opinion for the industry, but more importantly for America, and the executive order President Trump, and we eagerly await the follow-up discussion and to see what will happen.
There's nearly $4 billion in private capital invested into commercial space stations at this point. How do you think about the relationship between government anchor demand and private market momentum as you build Haven 1?
Our view is that there's obviously, to go fully commercial, you need a transition. And so in our business model, we need NASA as a customer, right? Not building their own station, but retiring the ISS and then purchasing service from us. When you have NASA as a customer, all of the other nations are following. The key ones is Japan and Europe, which are key investors in human spaceflight. But it's also a growing market of international space agencies with many more countries that are getting involved. You've had in the Middle East, the UAE, as well as Saudi Arabia getting involved in human spaceflight. You have many additional European countries that were not part of ESA doing it. And so it's a growing market, and we need that market to be able to successfully transition to fully commercial. In the vast business model, with that current market that exists that is verifiable of sovereign space agencies in NASA, and we can not only reduce the expense to the taxpayer, so provide a better service at lower cost, but we can do it and reach profitability. And then we all have the hope of new markets, so manufacturing drugs in space and make life better on Earth and cure disease. Media and entertainment, sponsorship, private individual buying mission. That's the new market that everyone that has a space station will get to develop. But in our business model, we are conservative. We are not attributing any material revenue to that. We look at the existing market of sovereign space agencies, and our low-cost approach, can get us to profitability there. Now, when NASA says they will become a customer and they are privatizing or they are moving to commercial, as they started to do in 2018, they send a signal to the investor community. And as you mentioned, that is raised between us and some of our competitor in this race to replace the International Space Station. That has raised more than $4 billion in private capital on this expectation of what will happen. So yes, clearly if NASA at the end says, hey, never mind, we will not be doing this, we'll just build our own, I think that will definitely hurt obviously the companies that have been planning for this, but it will also hurt the confidence in the government and NASA from the investment market that they can be a reliable partner, that you can wait for them over a long timeline and to fulfill the promise on which investors have made the bet in our companies. So, but once again, it's not decided. It is a proposal, and there are so many reasons why we believe the commercial path is the right path, and we have convictions, with data and arguments, and we believe that it will be a true dialogue, and we will find a solution that's great for America, for NASA, and the industry. So, so far, I think investors are asking questions and a little bit nervous. Where will it go? But I think the confidence, can remain full, assuming a valid path is chosen that makes sense.
Max, thanks for being here and for giving us the operator's view on what is genuinely one of the most consequential policy moments in commercial space right now. We'll be watching Haven 1 closely.
Great. Thank you, Chad.
Let's turn to the other major infrastructure story of the quarter, one that's been building for years and just hit a meaningful milestone. Starlink crossed 10 million subscribers in Q1. Let that sink in for a minute. 10 million paying customers for a satellite internet service that didn't exist 6 years ago. SpaceX is now tracking toward $20 billion in revenue in 2026. In mid-March, they reached 10,000 simultaneous satellites in orbit, building at approximately 5 per day. The commercial satellite communications market has found its anchor tenant, and it's enormous. SpaceX raised Falcon 9 list pricing to $74 million per launch, its fourth increase since commercial launches began at $61 million. Rideshare moved from 6,000 to 7,000 per kilogram. These are confidence signals. SpaceX is capacity constrained by internal demand, Starlink, direct to cell, and now orbital data centers. That constraint creates a real opportunity for Blue Origin, Rocket Lab, Firefly, and other new entrants to absorb commercial and institutional demand. 2 new vehicles came online in Q1, Firefly Alpha and Ariane 64. The ecosystem needs diverse access to orbit to remain healthy, and we're starting to see it. And it's not just connectivity that's seeing this surge. GeoInt, geospatial intelligence, is the sleeper story of the quarter. $3.8 billion invested in Q1 alone. That's 86% of all of 2025's GeoInt investment in a single quarter. The demand for real-time understanding of the physical world is accelerating faster than almost anyone expected. To manage all this growth in orbit, Khan launched the SatCat terminal this quarter, a Bloomberg terminal analog for orbital activity. Gives investors and insurers a new tool to query constellation health, expansion cadence, and anomalous satellite behavior. The orbital economy now has a data terminal. What comes next is pricing, risk models, and derivatives. NASA's lunar ambitions don't stop in low Earth orbit. The $20 billion lunar base program is going to require infrastructure on and around the moon that doesn't fully exist yet. My next guest is building it. Justin Cyrus is the CEO of Lunar Outpost, a space capital portfolio company building the surface mobility and resource utilization systems that make a permanent lunar presence possible. Justin, it's great to have you.
Thanks for having me, Chad. Good to talk to you again.
So NASA just committed $20 billion over 7 years to build a lunar base near the South Pole and scrap the Gateway. And as a company that's been building toward lunar surface operations, how does that change your roadmap, or does it validate it?
It validates it. What it did is 10x our beachhead market over the course of the last 2 weeks. It's been an awesome 2 weeks. We're building a moon base. It's going to be built out over the course of the next 5 years. And what Lunar Outpost is doing is providing the robotic and mobility systems that are going to make that a reality. So for us, we're really excited about the opportunity.
So Starship is now central to the lunar architecture. What does a Starship native lunar economy actually look like for a company like Lunar Outpost? I mean, does lower cost to surface change your business model?
Yeah, Chad, it's a critical differentiator to the lunar economy. I mean, at the end of the day, you're going from bringing 50 to 100 kilograms down to now bringing tons of surface mass down, which enables an entirely new lunar economy. You're going from exploration and science missions to now actually building a moon base. And that's a fundamental step change of what we've done over the course of the last 20 years. So when you're building that moon base, now you're building everything from the power, the communications, the habitats, launch and landing pads. And that infrastructure is going to allow us to build a commercial economy at scale. So overall, it is critical to the lunar business model. It allows us to put ourselves in a position where we're opening up new sections of the market that never really existed before.
Exciting. And so for investors and allocators watching this, what should they know about the lunar economy and NASA's moon base over the next few years?
Yeah, I think Jared Isaacman did a phenomenal job of not only laying out the plan and laying out the vision, but showing the market pull. Because what Jared put out is said, hey, we not only need one rover or two rovers, we need many rovers, we need many landers. We are going to undertake a historic, critical thing for not only humanity, but what we are going to be doing for the economy back here on Earth. So what investors should keep in mind is that this has gone from what we were estimating about last year, a $3 billion Artemis Space Camp is what it used to be called, to a $30 billion major infrastructure activity over the course of the next 5 years to build the first permanent outpost on another planetary body. So that's the first point. The second point is that's only one program within NASA. They canceled everything in low Earth orbit. There's CLD, it's not quite there anymore. Gateway, it's canceled completely. All of that money is going to be going to the lunar surface. And we have an international coalition of Artemis Accords countries that are going to be coming along for the ride. So you're looking at the $30 billion from NASA, you're looking at tens of billions of dollars from these international organizations and space agencies, and you're looking at an entirely new commercial lunar economy for the first time in human history.
That's a lot of growth in a short period of time. Justin, appreciate it. The lunar base is no longer a concept, and the companies positioning now are the ones that will define what that infrastructure looks like. Thanks for joining us.
Excellent. Thanks for having me, Chad. Really appreciate it.
Step back and look at what happened this quarter. The convergence of AI, geopolitics, and orbital compute is driving capital into the space economy at a pace and scale that would have seemed implausible 5 years ago. NASA is being restructured around commercial capability rather than legacy contractors. The orbital data center race has graduated from concept to land grab. And the anticipated SpaceX IPO, the largest in history if it proceeds at reported valuations, is forcing institutional allocators to confront a simple question. How much of this market do I own? And is it enough? The window to position ahead of this transition is not unlimited. The rails are being built now. Ownership is being decided in real time. I'm Chad Anderson, founder and CEO of Space Capital. This is SpaceIQ, and we'll see you here next quarter.